Well, hello. My name is Anthony Sicaro. I'm founder and president of Providence Financial and Insurance Services, located in the heart of the San Fernando Valley in Woodland Hills, California. I'm also an estate planning attorney, and for 5 years running, I was the host of the Providence Financial Retirement Show, which aired every Saturday on AM 870. KRL Lays the Answer. And the purpose of these videos is to keep my clients informed with regards to what's going on in economic environments and just to give everyone my thoughts. And so if you're a client of mine, thank you for your trust. Thank you for your business. You know I don't take it lightly. If you're not a client of mine and you hear something or you see something that you want to spend more time talking about, feel free to reach out to us. I'd love to schedule a quick 15-minute call with you. And probably the best way to do that is to reach us on our website at providencefinancialinc.com. So a couple of things that I want to just touch on in this video. The first thing is I want to do a little bit of housekeeping with regards to TD Ameritrade and required minimum distributions. And then what I want to do is just take just a few minutes and fill you in with my thoughts about where the market's likely to go from here. This is going to be one of my shorter videos. I've said a lot of what I've wanted to say in the past, but I just want to use this as kind of a quick reminder and answer some of the questions that I've gotten based on the results of the last couple of videos I've done. So first, housekeeping. TD Ameritrade. You might remember a video that I did towards the beginning of the year. I actually don't remember exactly. I want to say it was January or February because the government on December 27th passed the new Secure Act, and this act had to do with your retirement accounts and new rules, moving the required minimum distribution age to 72 for certain people and so on. Well then, as a result of the coronavirus, the government, what they have done is they've actually required, or I should say discontinued, the requirement for RMDs for this year. So what that means is that if you were supposed to take an RMD for 2020, then you don't have to take it. And if you want to know more about that, go back and watch the video. I did a whole video on the Secure Act. But for this video, just know as a reminder that you don't have to take your required minimum distribution for 2020 if you didn't want to. Now, here's the logistical problem that it has created for TD Ameritrade and for us. As a firm, most of you, we have put on automatic distribution. So that's very handy. Most of you like it. You don't have to think about it. We don't have to think about it. It's just going to be sent to you automatically. Our normal protocol is that we have them sent to you automatically in November. That allows you for the first part of the year to continue earning your interest and dividends and so on. And then when November comes, you automatically get your RMD. And that's just normal protocol. I'm going to say a high percentage of you are that's the strategy and the protocol that we're using. Others of you are doing it different ways. Others of you are taking it monthly. Others of you are just calling us whenever you want to take it. But we had to figure out what do we do for those of you that don't want to take your RMD. Quite frankly, most people take their RMD because they have to, not because they want it. And yet, from the reality is that we have hundreds of accounts that are affected by this. And if you call us up and tell us I don't want to take my RMD, then it's going to be a logistical nightmare because we got to turn it off this year and then we got to turn it on next year and make sure that nothing slips through the cracks in that whole problem. So it's been a challenge. So TD Ameritrade decided to handle it this way. They didn't call me to ask. They didn't call their other advisors, right? They're a multi-trillion-dollar firm. They just decided this is how they're going to handle it. And I think it's actually worked out very well, but I also want you to be informed as to what's going to happen from here. If your RMD is set up for an automatic distribution for 2020, whether it's monthly or whether it's annually, TD Ameritrade has made the dollar amount for your RMD 2020 distribution to be zero. So what they're doing is they're leaving you on an automatic distribution, but they're saying that for 2020, the amount is zero. So they were able to do that across the board, system-wide, by just pressing a couple of buttons. It was very easy for them. And then in 2021, it's going to be very easy for them to press a couple buttons and put you right back into your RMD schedule. So the bottom line is, if you are taking your RMD and you're only taking it because you have to take it, not because you want to take it, then you don't have to do anything because you're not going to get your RMD this year anyway. But what if you want it? What if you look forward to it every year and it's going to be coming automatically and this year you're not going to get it? Well, just call us. Call us and let us know you want it, and then we can go ahead and we can make the distribution to you manually, or we can do it automatically this year and leave you set up next year. Not a big deal. We can change that automatically. But I didn't want you to go through the end of the year or whenever your automatic distribution is set up and miss it and then wonder why you missed it. You will be missing it if you were set up for automatic distribution because they've canceled that for this year. So just wanted to give you that heads up, a little bit more of housekeeping than anything else. So hopefully that helps. Call my office with any questions. Next, let's talk about where the market is and where the market's likely to go from here. If we go back to the all-time highs of the market, which, hard to believe, was just 2 months ago, February 2020 was when the markets hit the all-time record highs, both the S&P and the Dow Jones. And by March, they had come down by about 40%. Now they've bounced back up. Now they're down about 18% at this point. Okay? So the reality is, everyone wants to know, where's it going to go from here? And the answer is, we don't know. It's the same answer I seem to be giving you all the time, right? The reality is that we don't know. If we knew, then we'd all be rich and we could quit our day jobs, but we don't know. And there are some people out there that are calling for a V-shaped recovery. Okay? A V-shaped recovery means the market drops and then recovers. It's like a V. And there are people that are thinking that we're going to very soon get back to our record high levels, or maybe close to our record high levels. I'm not convinced. Okay, and you probably know that from watching all my videos. As a matter of fact, I don't think we're going to have a V-shaped recovery. I think, if anything, we're going to have a U-shaped recovery, and I think we could be down at these levels for months, maybe years ahead. And this is not uncommon. When you look at market history, you look at these trends, this has happened many, many times. When you look at the crash at the beginning of the century in 2000, the tech bubble, well, that crash started in the early part of 2000 and didn't get to a bottom until 2002. It took about 2 years for that market to get to a bottom. And it didn't go like this. The way that the market generally falls is more like a feather. It's more like a feather falling out of a balloon, out of a hot air balloon, as opposed to a rock dropping in the ocean. A market generally doesn't drop like this. It generally will float down a little bit, and then it will catch a draft and stay there for a while, and then it will catch an updraft and go up a little bit, and then it will go down a little more and catch a downdraft, and you've got this feather that's floating. You've got this market that's floating up and down and trying to find a ground. But the general trend from 2000 to 2002 was down. Lots of bumps along the way, but generally down. The same thing with the crash of 2007, right? Crash of 2007, generally down. And it took until 2009 for the market to reach a bottom. And the crash in 2001 did not recover until 2006. So if you had a portfolio in 2000, it took a couple years to go down, and it took 4 or 5 years to go up, so that from 2000 to 2006, there was no growth in the market, 6 years. Then you go to look at 2007. It took from 2007 to 2009 to drop, but then it took until 2014 for the market to get back to even. 7 years. And that's what's called a U-shaped recovery. It's not really like a V. It's more like a downward decline over a couple years, and then it hangs down, and then it slowly comes back up. And, you know, there's a saying that the market takes the elevator on the way down and the stairs on the way up. And that's generally what we've seen happen. We've seen that happen twice in the last 20 years. And so some people are thinking that this is just going to be a rapid drop and recovery, a V-shaped. Other people like me are thinking that there's probably going to be more problems ahead, and it's probably going to be more of an elongated process. And the reason that I say that overall is because I really don't believe that the stock market is taking into consideration some of the things that are going to linger as a result of what's gone on with COVID-19. The stock market can't possibly be pricing in the amount of unemployment we're going to have or the amount of revenue decline that companies are going to have as a result of this. It's at these levels, even 18% down from our record highs. I just don't see how the stock market can be pricing this in. To me, it's unfathomable that we're even at these levels. And I think a part of the reason why we're at these levels is because the stock market has turned into a gambling game. As much as I hate to say it, I've talked about this in videos in the past where, the market gets down to a certain level and people think buy, 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 and they go in and they buy. And the market got down 40% and it pretty quickly came back up 20%, not because the fundamentals of the companies have improved, not because these companies are now so profitable and everything's doing well. No, it has nothing to do with that. You know that. If anything, people are being laid off and companies are going down the toilets, right? Small moms and popses and even big companies without revenue. So the fact that the market came up by 20% after dropping 40% has nothing to do with fundamentals. It has everything to do with people are just gambling. They're just using it as a short-term gain. And if you're in that category and you can afford to take some money and you know what you're doing, fine, have fun. But if it's your retirement on the line, you don't want to have anything to do with that. At least that's my opinion. So the market hasn't come back because of fundamentals. If we look at the fundamentals, I don't believe the market should be anywhere near where we are. And let's talk about that from a couple different perspectives. Let's talk about GDP. Let's talk about unemployment. GDP, gross domestic product. That's really the measure of how well this country has grown, right? That's what GDP is. So over the last decade or so, 12 years, the reality is that GDP, we've tried, the government has tried to get GDP to be 2%, and they've had a difficult time doing that. It's always been, somewhere in 1.6, 2%, especially in recent times. So 2% a year of growth, that's not bad. But the economic forecast for GDP for the second quarter has been predicted by Goldman Sachs to be negative 24% and by Morgan Stanley to be negative 38%. 38%. This has never happened. This is outrageous. I mean, this has just never happened. It's unfathomable. The St. Louis Federal Reserve president said that he thinks GDP can get as high as negative 50%. Now, he said some other things that people don't believe too, so I don't put too much stock in that, but negative 24% or negative 38%, that's just unthinkable. And the reality is this whole coronavirus it's creating a nightmare for all the paper pushers and the guys that like to crunch numbers, because you can't model this. This is really, truly an economic stoppage. You can't model an economic stoppage, and that's why you've got anywhere between negative 24% and negative 50% as guesses for what the second quarter GDP is going to be. Okay. And in the second quarter, everyone's kind of discounting. We're in the second quarter now. We're just starting to get into earnings season for Q1, and the numbers are going to be horrible. But the market knows that. The market knows that the earnings season and all the numbers are going to be bad, and so they've discounted that. So I don't think that that's going to affect the market at all. It's not going to have a lot of impact on that unless we just get some numbers that are even much worse than we thought. But the market doesn't seem to be taking into consideration the third quarter and the fourth quarter numbers, because the market seems to be thinking that when COVID stops and the world opens back up again, that everything goes back to normal. No, everything's not going to go back to normal. The reality is there's a lot of people that are feeling scared right now. And a lot of that has to do with unemployment, right? There's economists have predicted, matter of fact, I don't predict it. I think that they've already said unemployment is in the 13% range right now. They have predicted that it could get to the negative or the 20% level, and even as high as 25%, I've heard. So we haven't had 13% unemployment since the Great Depression. And in the Great Depression, unemployment was at 25%, and there's been some economists that have said that it could be greater than 25%. So I don't think the market's taken any of that into consideration. And if you're unemployed, or if you're in a situation where you're worried about your job, whether you might be unemployed, well, then you're not going to spend money. And as much as the government is trying to help and stimulate the economy and give give money to the people, the $1,200 to go out and spend, you're not going to spend that money. These people that are unemployed aren't going to spend it unless it's on things that are absolutely essential. That's it. And even when this whole thing ends, we're going to change how we work. We're going to change how we live. We're going to change how we think. A lot of people that have been unemployed and furloughed for a while, right, when they get back to work, they're not going to start spending money. They're going to pay off the debt that they've accumulated trying to live without income. So I really do think we have a long ways to go. And that's why I call this an economic stoppage. It really is truly an economic stoppage that is very, very difficult to model. But I really don't, in my heart of hearts, believe that it's going to be a V-shaped recovery. I don't believe that it's over. I don't believe in my heart of hearts that the market is taking this into consideration. I know I've said this before. In my last video, I kind of reiterated some of what I'm taking. The last video I did was 2 weeks ago, and the market was down a lot more. And I was talking about it then. Now the market's back up 20% at least from its bottom. And I've had a couple of people call me based on my last video, and I had one particular fellow who asked me a question I thought was a good question. And he basically said, Anthony, if you know for sure that the market is going to go down from here, then why don't you just recommend that all the clients sell all their investments across the board and then buy in at a lower point? And I thought it was a good question. But the key ingredient is he asked me if you know for sure. The challenge is we don't know for sure. That's the problem. And we also have to segment investments into two different categories as to what you're likely to do and the best way to handle both of them. If you're invested in the stock market and the stock market drops and recovers over a period of time, maybe 5 or 10 years, it drops and recovers, then you broke even. But if you're in income producing investments and the market drops and recovers, meaning your portfolio drops and recovers over a 5-year or 10-year period of time, you didn't just break even. Why? Because you were getting your income along the way. So the reality is if you're invested in stocks, that's a different recommendation than if you're invested in income producing investments. Income producing investments, you can ride it out. You keep getting your income. There's no loss. As long as you don't sell because you panic or because you need the money, there's no loss there. It's almost like if your property dropped halfway, if you had a $500,000 property that you rented out and it dropped to $250,000 and came back to $500,000, as long as you collected your rent, you don't care. But if you panic and sell, that's a problem. Or if you need the money in that time and then you have to sell it, then that's a problem. As long as you don't have to sell it, then you're in good shape. But that's not the case with the stock market, right? If the stock market drops and recovers, then you made nothing. You didn't keep pace with inflation. And on top of that, you're probably paying fees in the mutual funds or whoever your advisor is. You're probably costing you something. So you might have even gone negative if you have stocks that drop and recover. So I think it's important to understand that though we don't know for sure what's going to happen. Maybe we do have a V-shaped recovery. I hope that we do get back at record levels like you do, like you hope. I just have my doubts. So I think that's important to understand. And the last thing that I want to share is right now, if I'm right, then we're in the calm before the storm, or we're in the eye of the hurricane. And again, I could be dead wrong. We might not be, but we might be. And if that feather has just caught an updraft and it's just kind of floating around up, at some point in time, it's going to catch another downdraft. And I don't know what's going to be the cause of that directly. It could be that the world doesn't open up as fast as we think. It could be a resurgence in COVID cases. It could be that the world does open up and then it starts again and we have to get shut down again because the world opened up too early. It could be that the second quarter or the third or the fourth quarter results of companies are dramatically lower than the market is taking into consideration right now. It could be that a couple of household name companies go bankrupt. Companies that are too leveraged because they've been buying back their stocks all these years. There's a lot of reasons that could cause the stock market to catch another leg down. I don't know when, I don't know where. But I feel like we're in the calm between the storm. And your portfolios have also bounced back, right? The stock market's not back to where they were. Most of your portfolios are not back to where they started from, but they've come back. And if you're worried about the next drop, both in the market and in your portfolios, and you had a hard time maybe stomaching this last drop, then maybe we should talk, okay? Maybe we should have a conversation and talk about getting out before the next storm comes. Now, again, I'm not recommending that you get out. I think you should stay put. But at the same time, this is your money. Okay, I don't want you to stay put because Anthony told you to stay put. It's your money. You got to take the bull by the horns. I'm just the coach. And at the same time, I don't want you losing sleep at night. Okay, just because Anthony said stay put. So the reality is we've been prepared for this. We know that this is what's going to happen. You've heard my radio shows. You've seen me on TV. You've seen our website. This is nothing new. It's new for you because this is happening. Okay? I lived through the 01 crash. I lived through the 08 crash. Okay? So I can confidently say that you'll come out the other side just fine. We hope. And I only say that because, again, there are no guarantees, right? Not when you're invested in the uninsured items. By the way, for those of you that have the insured items, which include annuities, all the annuities that you have, some of you have annuities, some of you don't, but all the annuities are insured items. You don't have to worry about those. We're not talking about those at all. It's only the uninsured items, that the investments that you have at TD Ameritrade. Those are uninsured. That's what you're going to see fluctuate. And if you've been fine and you just know it's part of the game, it's fluctuated, and you know you keep getting your income and you understand the concept and it hasn't bothered you over the last 2 months that this has been going on, I recommend stay put. But if it has bothered you and you're thinking, well, if it goes down any more, then I'm going to get out. I actually had someone say that to me. They said, if it goes down any more, I'm going to get out. And my response is, why would you do that? Why would you wait till it goes down more to get out? But if you're thinking that, if it gets worse, I'm going to get out, I'm just going to suggest that it probably is time to get out now, okay? Because of the fact that it's probably going to get worse before it gets better. If you're concerned, if you want to have a conversation about that, call me, okay? Call me and I will be more than happy to have a quick 15-minute conversation with you, and we could talk about your situation and see if you want to stay put or see if you want to get out or talk about what your other options are. Hopefully that helps. Our website, providencefinancialinc.com. Feel free to reach out to me and look forward to speaking with you. And again, if you're not a client of ours, contact me. Schedule a quick 15-minute call. We'll have a quick conversation. Thank you and God bless.